Good morning, friends. This is your host Parthesh Shah, co-founder of Fintech, and you are listening to Night Snippets. Here is all what you need to know before going into trade for 12th October 2020. In the international market, in US market, the traders are still focusing on the additional fiscal stimulus negotiations with the hope the US 10-year closed at 0.79 and 30-year at 1.58 percentage points. In the crude oil market, on one hand, the economies are recovering, everything going back to normal at a very slow pace, and on the other hand, COVID-19 cases are still rising. The new work from home and virtual corporate conferences have started making inroads in everyone's life. We are not certain on how the long-term oil consumerism will behave, but for now, the upside is very much capped. Crude is trading at $42.61 per barrel, and we still maintain our long-term view with $50 per barrel target in next 3 to 5 months. In the currency market, dollar index is at 93.10. Once again, the dollar has started to weaken. Dollar index range is seen for today at 92.70 to 93.34. USD CNY or Chinese yuan, after a week-long holiday on Friday, it saw a major rally. The USD CNY, on the back of Democratic Joe Biden's lead in polls, his global trade policies, and China's strong domestic credit growth, the USD CNY is trading at 17-month stronger at 6.69. USD INR or Indian rupee, with a high of 73.29, closed at 73.06 on Friday. Again, 73.30 region acted as a resistance and it reverted from there. With strong Chinese yuan, we expect USD INR also to strengthen a bit, and most likely we will see a close below rupees 73 today if RBI intervention does not come. USD INR range for today would be 72.90 to 73.35, but the exact ranges will be available once the market opens. On the domestic front, on Friday, RBI Governor Shaktikanta Das gave one of the best MPC policies in recent times. Let's try to decode few of his policy stance and its impact on the bond markets. Number 1, repo and reverse repo unchanged at 4 and 3.35 percentage points respectively, with a further scope of rate reduction based on the GDP and inflation prints in the future. Number 2, remember, recently RBI had increased the HTM limits for commercial banks from 19.5% to 22% till 31st March 2021. But even after this announcement, there was hardly any interest seen from the banks to increase their HTM holdings due to futuristic M2M losses. Now the deadline for this extension has been increased to 31st March 2022, one more year, and then a gradual orderly decrease in HTM limits. Impact: banks will now be more comfortable increasing their HTM book due to one more year extension. But in our Knight Research's view, this will not make banks to increase their SLR holdings, as they will be focusing more on the credit growth rather than the SLR holdings, but definitely a positive signal for banks which can reduce their M2M losses. Number 3, OMOs in SDLs. This is a revolutionary step by RBI and have never been exercised before. The yields on the 10 to 12-year maturity decreased by 15 to 20 basis points on Friday itself, with the hope of further SDL GSEC spread reduction. We at Knight Research now expect SDL GSEC spreads to shrink a bit from the recent 88 basis point spread and will come back to 70 basis points. But there is a 2.02 lakh crore SDL supply this quarter, and majority of the banks are already done with the long-term buying. Also, the SDL OMOs from RBI will be a bit tricky, and we will have to watch out for more information from RBI. Number 4, on tap LTROs worth rupees 1 lakh crore. Again, this is one more interesting step from RBI, with few of the sectors where the benefits have not reached. RBI can use this tool. Again, even if RBI incentivizes banks to use this tool, it is yet to be seen on which sectors and whether the banks are comfortable with these sectors. In short, the last MPC policy guidance was much of a game changer. Before the policy, 10-year GSEC was seen with a 6% floor, and now with all these announced measures, we see 6% as a ceiling. For most of the part of this remaining fiscal year, 10-year GSEC will be seen between 580 to 6% with all the available information as on today. The SDL spreads will be 65 to 75 basis points, as states are in a very bad situation and all the market participants know this fact really well and will exploit the states. For near future, we at Knight Research are very bullish for the bond markets, and we will continue to watch the economic rebound, as it seems COVID-19 peak has already passed and we will see a strong rebound in credit growth. We at Knight Research are again very bullish on Diwali for credit growth, and that can kickstart our economy and reduce the worry for RBI. But the long maturity bond risk still prevails, but it has been delayed with lower rates for longer period of time, and RBI is trying hard with all these new unconventional measures for orderly shaping the yield curve. If you want us to comment on your portfolio risk, you can reach out to us on 9930307466 or research@knightfintech.com.